Hello and welcome to The Upside. I'm Jordan Chevalier. Joining me today is Institutional Portfolio Manager Ilan Kolet. Ilan is a member of Fidelity's Global Asset Allocation team. Ilan, thank you for coming on the show.
Thanks very much, Jordan. Good to see you.
So we're here, I think, mainly to talk about rates. The Bank of Canada, they paused rates. Were you surprised at this decision at all?
I would say, it wasn't a surprising decision, right? So the Bank of Canada has cut rates many, many times, right, since they started last year. We're sitting at 2.75% right now. There were large cuts at the end of last year and already a couple of cuts this year. But the bank is in a really, really tough position right now in terms of scenario analysis, and I know we'll get into that. But it wasn't overly surprising to us. What I would say is, we don't predict specific outcomes from specific meetings.
Right.
We knew rates were going to be moving lower from their peak, from their post-COVID peak, because they didn't have to be so restrictive, and the Canadian economy was, fragile to say the least, coming into this tariff shock. But they paused and have very, very clearly expressed yesterday in the press conference and in the monetary policy report in detail that they are ready to react, right? They stand ready to react. I think in the press conference, they said that a dozen times. They're ready to react to the incoming data or the balance of news as it changes. Now, unfortunately, it changes day to day, hour to hour at times, making the jobs of monetary policymakers and my former colleagues at the Bank of Canada all that much more difficult.
No, that's very insightful. And you mentioned the Canadian economy a little bit, specifically the housing market. I know that's top of mind for a lot of investors, the Canadian economy more broadly, but the housing market. How does that rate, sort of change the balance there?
Yeah, so the housing market, it's an interesting one, right? So post-2008, right, Canada came through the global recession sort of first or second best in the G7, sort of tied with Germany, I would say. And then rates moved much lower globally, including in Canada. And then Canadians did what low rates incentivize you to do. They bought houses, cottages, condos, sea-doos, right? They bought everything. And it was fine to manage that debt service, manage that amount of debt when rates were manageable and inflation was low. And then we got the largest inflation shock in 40 years, resulting in 475 basis points of tightening by the Bank of Canada in 18 months. And our view has always been, this is going to be problematic and challenging for Canadian households. So in Canada, we have full recourse mortgages, and sort of culturally, we pay that mortgage. But what we do is we cut discretionary consumer spending sort of to the bone to make sure that a mortgage payment gets paid. And we've already seen this, right? So the way to think about the Canadian economy and housing, and I'll talk a little bit more about housing in a second, is Canada was entering this trade and tariff threat in a vulnerable position to start with, right? Exceptionally high levels of debt because we were sort of over our skis on debt. And that debt was going to be renewing at rates higher than where it originated. So our concern has been, roughly 50% of outstanding mortgages renew between now and the end of next year. And that debt is renewing at a higher rate than where it originated. And again, I'm the genius who bought a house in Toronto in 2021. So, right, it's close to home. And that's going to be problematic. In terms of the actual mechanics of the housing market, it's really interesting what you're seeing, right? So if you had asked me how was the housing market so resilient, through the pandemic, I would say that wasn't really resilience. I think what that was an enormous increase in population. Canada's population grew by 3 million people in the last 3 years. That boosted demand. That made the housing market appear resilient. Well, not really resilient. There was some sort of creative math around mortgages. There was pent-up savings. There was households borrowing money from their parents or grandparents, right? So people were tapping lifelines to make that mortgage payment. A lot of those things have come away and are coming undone.
Right.
Population growth has reversed very, very rapidly. So that demand shock is coming away. Rates will be higher. And on top of that, we're contending with this tariff shock. So what I would say to anyone listening today, specific to their own mortgage, they should probably talk to their advisor. Right. This is a conversation you have with your advisor. But from our perspective, from the asset allocators, we're still concerned about the macroeconomic strength of Canada.
Okay. And if this is a pause that we've had this week, if they now, the next two decisions are cuts, let's say, right? Is that enough, do you think, for consumers, especially with housing, to kind of come off those sidelines? Or are we still looking for more? I know it's...
it's a very tricky decision. I think, it really varies by region, right? So for example, we often hear about in Vancouver and Toronto, consumers coming off the sidelines when you see those changes. I just came back last night from a trip to the prairies. I was in Regina and Saskatoon.
Beautiful.
So hello to everyone who's watching out there. There's such a huge housing shortage in some of those markets that houses are selling instantly, right? And you have to think about it. 0.25% is not suddenly perhaps bringing in a huge swath of buyers, right?
Sure.
Those buyers were there. But the other thing that we're seeing, and the Bank of Canada put out a survey at its last decision in March, showing hesitant consumers and households, right? So again, I don't want to be too scary, but in the type of environment we're in, if you have a job that might be exposed to the downside of tariffs, you're probably delaying large decisions, right? Not just the washer and dryer, but certainly the house, right? And so we are seeing that in the survey data, that households are holding more precautionary cash, and businesses are reducing hiring expectations, business investment decisions, right? So there's just a more cautious tone. And right now that's a cloud hanging overhead. Kind of have to wait to see what the weather looks like.
Very interesting. I think a lot of people before the Bank of Canada decided to pause rates, a lot of economists were sort of 50-50. They weren't sure if it was going to be a pause or a cut. But the trade war, right? This U.S. Policy, this whole environment that the U.S., Canada, and many others are in. Are you surprised at how this is all sort of the fallout in Canada? I think a lot of people were very, quite frankly, scared when it started. But economically, has it been a little bit more balanced with sort of, the pause to tariffs and some of the things that we've seen?
So it's an exceptionally difficult time to be an economist, to be an investor, and to be a policymaker. And what we've seen is, we've seen things from the Bank of Canada. We saw something from the Bank of Canada yesterday that we have not seen in a while, really since COVID, which is normally they, at the April Monetary Policy Report, which was published yesterday, they release their baseline forecasts. And they decided not to yesterday. Instead, what they did is they put out two scenarios. And actually, it sounds like they're sort of dodging the bullet, but it's actually much more helpful, right? Scenario analysis is much more helpful when the path forward is so uncertain.
Right.
So why provide false precision? Oh, the economy is going to grow by 1.8%. Like, the second decimal, we don't even know on a good day. It's much more useful to provide two distinct scenarios, which is exactly what the Bank of Canada did. And those scenarios were, under one scenario, it was tariffs get negotiated away. Right. So it's negative. It's somewhat negative, I would say, and results in sort of slower growth, but they get negotiated away ultimately. And the second scenario that they put forth was the downside scenario, a long and protracted trade war, a recession, right? Job loss, declines in investment, declines in consumer spending, right? A really negative scenario. And what they expressed in the press conference is that we're probably somewhere in between the middle of these two things.
Right, okay.
The hard thing is the news flow changes so drastically. It's very, very hard to come up with an actual base case, and scenario analysis actually makes more sense. In the context of our funds, we use scenario analysis as well. I very rarely get to talk about it, but we work with a really, really strong asset allocation research team down in Boston.
Okay.
We speak to our underlying managers in Canada, in the US, overseas, and we also have scenario analysis in terms of what it could mean for our funds, if we get scenario A, B, or C.
Sure.
And the way that we position in our funds is the size of a position in one of our funds reflects the conviction in the view, right? And so right now, we have taken steps, and we discussed this in our Elbows Up paper published 3-4 weeks ago. That is investor friendly, I would say. We've taken precautions, right? We're leaning away from the US, we're leaning away from Canada, right? Regions that would be hit quite hard. We're leaning into Europe, signs of galvanization there, and we've added to inflation protection because the type of shock that we're thinking about right now is less growth and more inflation. Right. It's damaging, and it's very, very difficult for policymakers.
Looking, you mentioned this sort of scenario A, where let's say we're in a pause now, by and large, things get negotiated away. Is there any sort of upside to any sort of Canadian markets that you'd say, in that scenario?
Yeah, so this is a really tricky question. It's very hard to think about upsides in the presence of the kind of volatility and uncertainty we're dealing with right now. But you can, if you look hard enough, you dig deep enough, there probably are some silver linings. So, for example, we have been talking about for decades in Canada removal of interprovincial trade barriers and diversifying our export trading partners, right? So interprovincial trade barriers, I mean, a lot of them are, I would say, sort of cumbersome and impede business. If the fire has moved closer to us to actually get rid of these things and just trade better within Canada, that is a net positive. Now, it doesn't happen overnight, right? These removal of these barriers takes time. And there's a lot of interesting research around interprovincial trade barriers. But the other one, and I would say this is far more critical and important, is we need to diversify our export base. So to put these numbers in perspective, roughly 30% of Canadian GDP are exports. That's large. Right? To put that in perspective, housing is about 10, a little bit less than 10. But 80% of our exports go to one customer, the US. So roughly 20% of Canadian GDP by itself is just exports to the US. I mean, we have one customer, and you're vulnerable when you have one customer, right? And so we absolutely need to diversify our export base, our trading relationships. Now, the thing is, as I highlighted on a Fidelity Connects with the great Theo Argyris a couple of weeks ago, we actually have a trade agreement with Europe. Hasn't really amounted to much. But my hope is this sort of leads to a bit of galvanization in Canada to get some stuff sorted. And really what we're looking for here, not to get too nerdy, is productivity growth and an increase in potential growth, right? So again, we've been very productive about talking about productivity in Canada, but we haven't actually had the productivity growth.
Right.
And we need to sort out this issue and get some of these large infrastructure projects over the line to boost growth. And it's urgent now.
Absolutely. And I think a reason why some would say it is urgent, yourself included, there's sort of the recession fears. Maybe also his recession's scary older brother, stagflation. Right? Are these fears, I mean, sort of, I know it's hard to predict and we're looking at scenarios, but are these fears, are they real for Canadians?
They are, and they should be. They absolutely should be. So again, I don't want to be alarmist, right? So we're always going to position the funds to not just add value when the line is moving up, but preserve basis points and do better when the line is going down, right? And again, your advisor is the person to really reach out to talk to about this. But under the downside risk of severe tariffs that last a long time that don't get negotiated away, that is a recession risk. Right? It is declines in GDP. It is job loss, and it would be rough. The Bank of Canada knows this, right? And they are waiting and ready to react to cushion the blow of this downside shock in the event that they need to. What makes it difficult, Jordan, is exactly as you mentioned, is stagflation, right? So again, stagflation is less growth or declines in growth, right? A recession, coupled with high inflation. From a central bank perspective, this is particularly tricky, right? The Bank of Canada has one job, it's to keep inflation between 1% and 3%. But in the event of a significant shock to growth, right, that leads to job loss, that leads to less exports, that leads to less business investment, less consumer spending, they would have to trade off some higher inflation temporarily and push rates lower in order to sort of stem the bleeding or mitigate the downside damage from that recessionary shock, right? And they would do that, and that they would communicate it exactly, I think, in that way. But the difficult thing again is we don't actually know the path forward, right? So again, I spent some time with advisors out in the West, and we were at Revelstoke, right? And the news at the bottom of the chairlift on tariffs was different than when we got to the top of the mountain, right? So this is changing minute to minute, hour to hour.
Yeah.
We're not going to position our funds every single day differently based on the news flow. That's what we're not going to do. But what we are going to do is we're going to lean away from asset classes that we think will lag, right? The US and Canada. We'll lean into spots that we think can do well, Europe, and we'll add to inflation protection, right? So gold is the best example I can provide, right? So gold has been that reliable inflation hedge. We've added to it meaningfully, starting last month, 2 months ago, and it's been beneficial in terms of preserving those basis points.
Is there something from an investor's point of view that they could look for to say, okay, maybe we're coming out of this sort of recessionary fear period? Just a sort of a signal, maybe not a green light, but maybe even a yellow signal that things are trending in the right direction.
I think investors, advisors, they're watching the same news flow that we're watching, right?
Yeah.
So we watch it very, very closely. But this actually speaks to exactly the benefit of working with an advisor, right? So for investors that are listening, you reach out to that advisor, have that conversation. They can certainly tell you the Fidelity perspective. We put out lots of videos, lots of webcasts, lots of papers, and we attempt to make all of those very, very jargon-free and accessible. But this is exactly the time when you don't want to underreact, right? So like we have in the, you don't want to underreact, but at the same time, overreacting is just as damaging, right? If you had overreacted, for example, in COVID or in any sort of downturn, you'd likely be poorer today than you were before that event, right? So that stick handling we do from an investment perspective in the funds, and your advisor can help with in terms of navigating the sort of stressful day-to-day situations of that.
Yeah, absolutely. Are there any things before we go here, sort of some final thoughts to investors, Canadians, and advisors, right? Everybody watching this show, things that you can leave them for, maybe in sort of the short to mid-term.
Sure. Yeah. So first, I want to thank everyone for their support, right? There are over 600,000 individual investors in the managed portfolios, probably close to or above 1 million individual investors in our total fund suite that we manage, that $100 billion group of funds. And the way that we've achieved the results that we have and the peers beaten at the 1, 3, 5, 7, and 10-year horizon is a very, very research-based incremental approach to portfolio management, right? So the pillars, macro, bottom-up, valuation, and sentiment, which we've talked about in many papers, that is the process that we will follow and continue to follow to navigate this really difficult time, right? And that's what we'll continue to do. And again, with the partnership of advisors, this has been sort of, I think, the key to the success.
Well, this has been a great chat. I know I speak for all investors. There's a lot of great things to take away from here. So thank you again, Ilan.
Super. Thanks, Jordan.
For more insights from Ilan and the GAA team, check out their latest thought leadership paper entitled Elbows Up, available now on fidelity.ca. Thank you for joining, and see you next time on The Upside.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.